8 timeless principles of investing. Number 1, focus on what you can control. Market movements, business decisions, economic events, politics, interest rates, many factors can influence the performance of your investments. Instead of worrying about events that are out of your hands, focus on what you can control. Build an investment strategy that reflects your goals, time horizon, and risk tolerance. Diversify, but remember that diversification is an approach to help manage investment risk. It does not eliminate the risk of loss if security prices decline, and manage your tax situation. Number 2, put time on your side. The financial markets have rewarded long-term investors. The chart shows how various asset classes have performed over time. Keep in mind, however, that past performance does not guarantee future results, and individuals can't invest directly in an index. Number 3, tune out the noise. News cycles driven by fear, uncertainty, and doubt can challenge even the most disciplined investor. Some headlines spark anxiety, while others try to goad you into chasing the hottest fad and trend. Although we live in an era of seemingly infinite data, information overload can cause you to reconsider investment decisions. Number 4, don't try to time the markets. Market timing is a strategy of trying to predict future market movements to time buying and selling decisions. When markets are rallying or pulling back, it can be very tempting to try to seek out the top to sell or the bottom to buy. The problem is that investors usually guess wrong. Another approach is to focus on time in the markets, which may let you ride out the natural market cycles and focus on your long-term goals. Here are 3 tips to help you manage your portfolio. First one, determine your time horizon. Understanding your time horizon is a critical first step in determining what type of investments may fit your overall strategy. Second one is be patient, not reactive. It's natural for the markets to fluctuate during periods of volatility, so focus on managing your emotions rather than making changes to your portfolio. Third thing is start early. The earlier you start, the greater the compounding potential. If you start saving and investing early, you may gain an advantage over someone who wants to save and invest. Number 5, understand all forms of risk. Market risk, or the risk of your portfolio losing value due to factors such as changing market conditions, isn't the only type of risk to be concerned about. Personal risk, such as longer lifespan and rising healthcare costs, means that Americans need to consider a variety of factors as they prepare for retirement. Understanding risk as it relates to your time horizon and investing goals is critical to a financial strategy. Number 6, avoid the emotional roller coaster. Emotional decision-making can lead to making the wrong decision at the wrong time. A Delbar study found that while the S&P 500 returned 9.85% for the 20-year period ending in 2015, the average investor fared worse, seeing a return of only 5.19% during the same period. Emotional decision-making was one of the factors that contributed to the difference in performance. Number 7, the cost of procrastination. The sooner you begin investing, the longer your money can work for you. Let's look at 2 hypothetical investors. Sally starts and Dave delays. When Sally turns 50, she starts contributing at $25,000 a year to an account that earns a hypothetical 6%. After 10 years, she stops making payments. Dave puts off his investing program. At age 60, he begins setting aside $25,000 a year into an account that earns a hypothetical 6%. Though both have contributed equal amounts, Sally has the magic of compound interest working for her. When they both reach age 70, Sally's account balance is nearly twice the size of Dave's. Number 8, delegate the details. We can help you create a customized portfolio strategy that's built around your unique goals. Though we can't control the markets, we can help you use them to pursue your long-term financial goals. To learn more about investing, I have a webinar on investment strategies for volatile and uncertain markets. The webinar link is in the description. Your plans for the future shouldn't have to depend on daily fluctuations in the stock market. Gains and losses are part of investing. By using deliberate, time-tested approaches, you may be able to pursue your goals without feeling as though you need to constantly adjust your portfolio to react to today's news. Again, the webinar link is at the bottom. Click it, and we'll see you there.